2 Nobel laureates, a legendary bond trader, and $1.25 trillion in derivatives exposure. Long-term capital management controlled $129 billion in assets on just $4.7 billion of equity. Their models said the risk was manageable. Then, one day in August 1998, markets erased $553 million. The geniuses behind this fund didn't just break it, they nearly broke Wall Street. And it all started with a bet so small, most traders wouldn't even bother. John Meriwether's name carried serious weight on Wall Street long before long-term capital management opened its doors. As the former head of bond trading at Salomon Brothers, he'd weathered both windfalls and scandal, earning a reputation as a master of the bond markets, someone who understood the subtle mechanics of treasury pricing better than almost anyone alive. In 1994, after leaving Salomon in the wake of the Treasury auction controversy, Meriwether set out to build something new, a fund that would combine trading instinct with scientific precision. He didn't do it alone. By his side were Myron Scholes and Robert Merton, two academic giants whose work on option pricing had just earned them the Nobel Prize in Economic Sciences. Their presence on the advisory board sent a clear message. This was not just another hedge fund. This was a laboratory for financial innovation, where the boundaries between theory and practice would dissolve. In early partnership meetings, the team set an audacious goal: to exploit tiny, fleeting price inefficiencies in government bonds using quantitative models, while limiting their own equity exposure to just a fraction of the total risk. The pitch was irresistible to the world's most sophisticated investors. On the 1994 roadshow, Meriwether, Scholes, and Merton presented not just a strategy, but a vision. Absolute returns, market neutrality, and low volatility, all backed by mathematical rigor. The promise was simple: the best minds in finance, applying Nobel-winning theory, would deliver steady profits in any market. The response was overwhelming. Major banks, pension funds, university endowments, and sovereign wealth entities rushed to commit capital. Within months, LTCM had raised $1.25 billion in equity, an unprecedented sum for a fund with no track record. Early press coverage reflected a sense of awe. The Wall Street Journal called LTCM the dream team of finance. Investors saw the Nobel credentials in Meriwether's trading record as a shield against risk. The money flowed in on the strength of reputation alone, with little scrutiny of how much leverage or complexity might be hiding beneath the surface. The founding partners became stewards of other people's billions, insulated by trust in their intellect and models. As the capital piled up, so did the confidence, setting the stage for a level of unchecked risk few could imagine. The aura of genius would prove powerful enough to silence most doubts, at least for a while. A sliver of yield, often just 2 basis points, separated the most recently issued Treasury bond from its older sibling. For long-term capital management, this tiny gap was the opportunity. The fund's core trade was simple in concept, but monumental in scale. Buy the cheaper, less liquid off-the-run Treasury, sell short the more expensive on-the-run version, and wait for the difference to close. On paper, the strategy looked almost riskless. Historical data showed these spreads rarely moved much, and when they did, they usually snapped back fast. But the math only worked if the trades were big, unimaginably big. To turn a 2 basis point spread into real profit, LTCM borrowed at a scale that dwarfed its own capital. By late 1997, the fund controlled $129 billion in assets, all resting on just $4.7 billion in equity. That is a leverage ratio of 25 to 1. The derivatives book was even more staggering: $1.25 trillion in notional exposure, much of it tied up in interest rate swaps and Treasury futures layered on top of the bond trades. The financing engine behind this leverage was the repo market. LTCM posted treasuries as collateral, borrowed cash at rates just above LIBOR, and recycled the funds into ever larger positions. Repo haircuts were slim, 5% on the most liquid bonds, 8 to 10% on the rest, allowing the fund to multiply its bets across dozens of similar trades. Inside the partnership, the risk models offered reassurance. Value at risk calculations, built on the assumption that market moves followed a normal distribution, suggested that even in a bad month, losses would stay within manageable bounds. The models treated the odds of a catastrophic event as almost vanishingly small. But not everyone was convinced. In 1997, risk officer Michael Ricketts circulated a memo warning that the models ignored the possibility of multiple spreads widening at once, that real markets could lurch far beyond the tidy bell curve. Senior traders like Victor Hagani pushed back, arguing that diversification across hundreds of trades made such a scenario nearly impossible. The debate ended with the models prevailing and leverage rising. By the start of 1998, LTCM was exposed on all fronts: $129 billion of assets, $1.25 trillion in derivatives, and a capital cushion that could be wiped out by a move of just a few basis points. The logic of convergence trading, so convincing in calm waters, now depended entirely on the world behaving as the models predicted. The smallest miscalculation, the slightest tremor in the market's confidence, could threaten the entire structure. August 17, 1998. The Russian government announces it will default on its domestic debt and devalue the ruble. In an instant, the mood across the world's financial markets changes. Investors, alarmed by the sudden collapse of a major sovereign borrower, scramble to protect themselves. The safest asset, United States Treasury bonds, becomes the only refuge. Money pours out of riskier markets and into treasuries at a historic pace. This global flight to quality does not follow the tidy logic of LTCM models. In days, the yield curve flattens, and the gap between on-the-run and off-the-run treasuries, the tiny spread at the heart of LTCM's strategy, collapses. Instead of drifting wider as panic spreads, the difference compresses sharply, moving in the exact opposite direction of the fund's bets. The models, built on years of stable data, had not foreseen a world where every investor wants the same exit at once. The speed of the reversal is staggering. Spreads that typically move by fractions of a basis point now close by several points within hours. For LTCM, each tick tighter means a loss multiplied across billions in notional exposure. The trades that once seemed unshakable now look exposed, and the firm's massive leverage turns a modest move into a crisis. What had been a textbook market-neutral position is suddenly bleeding capital, as the math of convergence gives way to the chaos of a global stampede. The shockwaves from Moscow have reached Greenwich, and the storm is only beginning. August 21, 1998. In a single trading day, long-term capital management lost $553 million. The math behind this figure was simple, but the consequences were anything but. The fund's massive convergence trades, spread across $129 billion in assets and $1.25 trillion in derivatives, meant that even a minor market move became catastrophic when multiplied by 25-to-1 leverage. Margin calls arrived in waves. Clearinghouses and prime brokers demanded more collateral than LTCM could raise. With capital draining fast, the fund was forced to liquidate positions at fire sale prices, deepening the spiral. By mid-September, what had been a $4.7 billion equity cushion had shrunk to just $600 million. The collapse was no longer just LTCM's problem. Major banks, including Goldman Sachs, Merrill Lynch, UBS, and Credit Suisse, faced billions in exposure. A disorderly liquidation threatened to unleash panic across global markets. On September 23rd, the New York Federal Reserve summoned the heads of 14 of the world's largest financial institutions to its boardroom. For hours, they pored over LTCM's books and debated the risks. The solution was a $3.625 billion cash injection from the banks, pooled together in a last-ditch rescue. In exchange, the consortium took control of LTCM's portfolio, with strict oversight and a mandate to unwind positions gradually, avoiding a broader market collapse. This was not a government bailout. The Fed acted as coordinator, not as lender. The private sector absorbed the pain, but only because the alternative, a cascade of defaults and a frozen credit system, was unthinkable. In the end, the rescue bought time for an orderly wind down, but the message was clear. Even the most celebrated minds, armed with Nobel-winning models, were powerless against a liquidity crisis that defied statistics and theory. Today, algorithms still promise precision, yet financial markets remain shaped by fear, not formulas. The same appetite for leverage and model-based certainty persists in new forms. The collapse of LTCM is not just history. It is a warning. When risk becomes abstract, the fallout is always real. Share your thoughts below.